So welcome to KWC, welcome to Kingdom Wealth Creators. This is learning session 14. It's open to the public. Anybody who's clicked on the link can come in. And it's because it's Independence Day in the US. No, kidding. Okay, it's not because of that. It's just free. I thought, as many people, because futures and options is something that a lot of people misunderstand. And because they don't know it well, they tend to lose money in it if they get in without understanding it well. So I want people to understand what futures and options. Okay, so let's look at this. Okay, now the first thing, futures and options. The first options market started way back in 1973 when the Chicago Board's Options Exchange started. They initially were doing this for agricultural products. People who grew wheat and soya and maize and cotton, all of these products that you see in the US, potato, and so it is created to help hedge agricultural prices. Now, when I mean hedging, what I mean by that is, suppose I'm a wheat farmer and I want to, and the current price of wheat is $100, okay, per quintal. And so I see that and I say, oh, okay, that means I can do wheat this summer. I will plant wheat because wheat's price is really good. But the problem is now a lot of people would see that price and say, hey, let's all do wheat. And suddenly by the time harvesting comes, a lot of excess wheat is produced. And suddenly you won't probably get the 100. You might end up getting 5 or 10 or 20 per quintal, right? And so you got in thinking you would get 100. You end up with 5, 10 or 20. And sometimes that can be a loss because the amount of the money that you put in to, grow that much wheat might be even more than what you're going to get. So what farmers, especially farmers, they decided is to hedge their prices. So if they see 100 and they say, okay, I want 100 for my wheat that is going to come in 7 months time, they would buy a future, or it was called a forward back then, a forward or a future, where they will say that 7 months or 8 months from now, I'm going to give you these many quintals of wheat and you give me this much. This is the price. Okay, so that was why actually options and futures were created, to hedge agricultural prices. But today you can see that it is in all commodities. We have it for natural gas, crude oil, gold, silver, aluminum, you name it. Most of the commodities have futures and options, and shares. Okay, nearly every country, every stock exchange has futures and options. Now in India, it started in 2001. Okay, India introduced options and futures only in 2001. So it's barely been 20 years since it started. It's been almost 50 years since it started in the US. But here's the amazing part. Today, India is the largest options market in the world. Okay. In fact, nearly 80% of the volume traded today in India, whether it's cash shares, futures, or options, 80% of it is options. That's the amount of how the volume of options is really powerful tool, and it's got huge volume, and 80% of the volume in the market today is actually options. Okay, now what are these things? Okay, now I told you there's forwards, there's futures, and there's options. Okay, so what are forwards? Forwards are basically, let me give you an example. Like I said, I'm a wheat farmer and I see the price is right now 100 for a quintal, and so I would buy a future, a forward, which says that I want 100 for my, and someone is willing to buy it from me. Okay, so when I do that such a trade, suppose you're someone who's buying wheat and I'm the farmer, we come to an agreement. Okay, 8 months from now, I will produce so much wheat, or whatever wheat I produce, I will sell it to you at this price. Now, you know why people do this? Suppose it was 100 today. Okay, the wheat price was 100 today, and people started planting, and there was a drought or a famine. Something happened. Not enough rain, and so suddenly during harvest time, there's not enough wheat, so the price of wheat will shoot up, right? So sometimes it might be 200 per quintal. Now, the guy who buys the wheat, so suppose you're the person who buys wheat because you want to make Kellogg's, okay? You're from the Kellogg's company, you want to make cereal, and you need wheat. Now, you realize, oh, man, at 100, I could have bought it, but now it's 200, it's too expensive. So what happens? The wheat farmer, me, and you, the wheat consumer, the Kellogg's guy, we make an agreement. I will say, I will sell you all the wheat I have at $100. I need $100. And you will say, oh, that sounds great, $100. So 8 months from now, when the actual harvesting happens, you will get whatever wheat I produce, and I will get $80 per $100 per quintal. Okay. whether the price at that time is 70, 20, 0, 200, 800, 1000, whatever. Done. Okay, at 100, the trade gets done. That's forward. Okay, now futures is kind of similar, but here the difference is there's no fixed price. Okay, uh, for example, this is let's explain this. This is actually more of a fixed lot. Now imagine I'm again a wheat farmer. You're the Kellogg's guy, and you want 100 tons. Okay, you don't care what the price is, but you want 100 tons because you are afraid that there won't be enough wheat on the market, and so you want to make sure you get 100 tons. Now I'm one of the biggest wheat farmers in Ohio, okay, in the US, and so I usually produce somewhere between 100 and 200 tons. So for me, price is not the issue, but I have produced a lot of wheat. So I need to somehow sell this off, right? So we will both get into an agreement. I will give you 100 tons of wheat. You will give me what is the price of wheat at that time. So what are we doing? We are making sure that at the end of this contract, we will get 100 tons traded. Because I want to get 100 tons away from me. You want to make sure you get 100 tons of wheat. Okay, price is not the issue there. In the forwards, the price is the issue, not the amount of wheat that we produce or sell. But in the futures contract, the quantity is the issue, not the price. Okay. Now, options is a more interesting thing. Okay. Now, imagine this. Okay. Now, there's a third person. He's someone who he thinks that there's going to be a lot of wheat going to be produced, and so or maybe there's not going to be enough wheat produced. Okay, just imagine there's not going to be enough wheat produced, and he predicts that there's not going to be enough wheat produced, and so he wants to buy wheat now. Okay, now the problem for him is that he might not have enough capital. Okay, so 100 tons of wheat at $100 per quintal. That's almost $100,000. He might not have $100,000. So what he will do is, if there's an options market, he will say, hey, I will give you whatever the price of the wheat is, okay, at that time. I will give you I'm imagining that it's going to be 120. Okay, so what I'll do is I'll buy an option saying that I believe it'll reach 120. Right now it's 100, so it's going to be 120. I pay a premium of say 10 or 15 rupees, predicting that the price is going to be 120. So what I'm not paying 120. You notice I'm paying something between 10 and $15 and saying that the price is going to be possibly 120. Okay, that 10 or $15 is something what we call premium in options. Okay, I'll show you examples of this. Now what happens? 8 months down the line, the wheat price has reached say 130. Okay, it was 100, and at that time that option person said, you know what, I think it's going to be 120, so I paid $10 or $15 for a 120 strike price option. Now when it's $140, $130 8 months from now, what happens for the $10 or $15 that he paid per quintal? He's going to end up getting a profit of 30. Now what if the price was 90? He will have lost that $10 or $15. He's not going to lose, $25, $35. He's only going to lose that $10 or $15. So that's an option. It's okay. So basically, if you have say wheat is the underlying commodity or the actual share of the market, say Reliance, a share of Reliance. A futures is a derivative of this underlying commodity, and the options is a call on the derivative. Okay, so what this is basically the underlying whatever commodity or share. Okay, futures is basically a derivative of this, which says that, hey, 3-4 months from now or 5 months from now, this is what I predict it's going to be, and so I want to buy it then, and it's kind of this thing, so I'm buying a future. But the options guy is saying, you know what, I don't have that much money to put in, but I'm going to predict what it's going to be like, the price, and I'm going to pay this premium, and so it's kind of a offset of the future derivative. Okay, so these are the 3 things that we normally see in the F&O market. Forwards, we don't see it much today, at least in the share market. But futures and options we see. In fact, options, like I said, is the largest market in India. Okay. Now I'm going to explain a few things. Okay. Now strike price. This strike price is like, when I said 120. So options always have something if you've noticed options, you will see the name of the commodity or the company, the share. I'll give an example. Let's go down here. Now, if you look at this, okay. Now, HDFC, if you look at here, HDFC is the share, right? It's the underlying share. HDFC July future is the derivative or the future. Now you can see this July, August. So every month has a future contract. Okay. Then if you look at the two options below, HDFC July 1000 P and HDFC July 1000 C. So the 1000 is the strike price. Okay, you get that? The strike price is 1000, and PE is a put, European put. Okay, option PE. Okay, the European part. Okay, but it's basically a put option or a bearish option, and the CE is the call option or the bullish option. Okay, so that's basically what these things are. Okay, now let's look at these 5 things in order. Right, strike price. So like I said, strike price is the price you think this is going to reach. All right. Then what is the option premium? Now, option premium is basically the money that you're going to pay for that option. Okay, especially when you buy an option, the option premium is the money that you're going to pay for the option. A break even. So for example, let's go back to the wheat farmer, the option buyer on the wheat. Okay, the price right now is 100, and he's paying an option premium of say 10 to 15 dollars. His break even is when it reaches 115. Okay, anything above 115, he's making a profit. Anything below 115, he's making a loss. Okay, so that's the break even point. Expiry date. Every option has an expiry date, like we saw before. July. Okay. Now for Nifty and Bank Nifty, for example, they have weekly expiries, but all the other shares have monthly expiries. So you can see the futures have July expiry, August expiry, July expiry, July. So those contracts that you buy will expire in July. If you buy an August contract, it will only expire in August. It cannot expire before, it cannot expire after. It has a specific time, a date when it expires. Margin money. Now, margin money is something that people don't understand a lot. So I'm going to explain that with a real example. Okay. Now, if you look at this example, you can see that I bought an HDFC July 180 call option, right? So you can see HDFC, which is the name of the company. 30th July is the date when it expires. 180 is the strike price, and it's a call option. Now, you can see normal. Basically, it means that you can do an intraday with MIS. But normal is when we hold it for more than a day. 300 is the lot size, okay? The number of shares in an option or a future or an option for HDFC is 300 shares, okay? And then if you look at 115 is the price I bought it at. Actually, I bought it at 61. This is what happens at the end of the day. It calculates what was the previous price or what's the current price. And so if you actually look at this, you will think I made a loss. But actually, I didn't make a loss. I bought this at 61. Today, it's at 104. But on Thursday, it closed at 111. And on Friday, it closed at 104. And that shows the, the day loss. But actually, it's sitting at a huge profit. Similarly, for a future, natural gas, 28 July future. Again, normal is because I'm holding it. If it was intraday, it would be MIS. One lot of futures, natural gas futures. That one lot is actually 1,250 barrels or cubic BBLs of natural gas. Okay, so that means that for 1 rupee move in its price, I can gain or lose 1,250 rupees. So you can see here 132.10 closed at 132.60. That means in the day I made 625 rupees. Okay, and okay, so let's look at span margin and exposure margin. Now this is something that a lot of people don't understand, and they you got. I'll try to explain this to you. Okay. Now this is the margin that they are asking for me in Finvase for the natural gas future that I bought. Okay. I cannot buy a natural gas contract. Okay. I cannot buy a natural gas contract if I don't have 36,250 rupees in my portfolio. Now you can see I have about 3+ lakhs. Okay, but 36,000, I need that much money before I can buy it. What is this exposure margin? This is the margin that I have to pay per day or the margin that I have paid to enter it. So when it comes to MIS intraday, this is not an issue, but this is okay. But when I hold it, this is the amount that they're keeping in holding against me. So when I'm holding a future, or this is the amount that the 36,000 is the amount that they have taken from me to keep in case the price goes down against me. So if I've gone long and the price goes down, I'll make a loss, right? So they'll take the money from this. In case I've gone short and the money goes, the price goes up, that means I'm making a loss. They will take it from this. So in the market for futures, every day that you make a profit, they will add money to your account. Every time you make a loss, they will take money from your account. Okay. That's basically what span margin and exposure margin is. So for crude oil, for example, if you're holding it, the exposure margin is 4 lakhs, okay, because it's very volatile. For natural gas, it's about 36,000. For Reliance, the future that I bought, it was about 2.1 lakh. The HDFC Bank future that I bought was about 1.4 lakhs. And so you need that much money in your account before you can buy or sell that future, right? That's just something that you got to understand: span margin and exposure margin. All right. Now let's come to calls, puts, options buying, options writing. Now I said CE is calls, PE is puts, and option buying is basically when I buy either a call or a put option. Option writing is when I sell either a call or a put. Okay, so just want you guys to know these terms. Now let's look what is the difference between an option call and option put. Now a call is basically a bullish view. So for example, I bought HDFC, right? I bought an HDFC call option. Why? Because I believe that it is going to be bullish. I bought the HDFC call option when the price was at 1,783. Why? Because I believed that the HDFC share is going to shoot up. Today it's at 1,883. So that is why I bought a call option, because I had a bullish view. What if I had a bearish view? Then I would have bought a put option. Okay, and so now I want you to know that this can be replicated by selling also. For example, I can sell a put option if I have a bullish view. So if I have a bullish view, I can either buy a call option or I can sell a put option. If I have a bearish view, I can either buy a put option or sell a call option. Now, what is the difference between buying and selling options? Okay, so let's look at option buyer versus option seller. And now option buyer can either buy a call option or buy a put option. An option seller or an option writer can either sell a call option or a put option. Okay, let's look at this. The buyer has limited risk. For example, the HDFC, the option that I bought, it cost me 18,300. Now, what happens if it goes to zero? I will only lose 18,300 rupees. But the seller, when he sells that call option and it is gone against him, today he has lost. So when he sold, whoever I bought it from, he sold me the call option, right? He sold it at 61 into 300, 18,300. So when he sold it, he got 18,300. But today its price is 103, right? 104. So right now he has lost 61.43 rupees, or almost 12,900 rupees he's lost. Okay, because it's gone against him. Now, what happens if this price keeps continuing going up? He's going to keep losing more. So the seller has unlimited risk. Okay, buyer has limited risk. Seller has unlimited risk. The buyer has unlimited reward. And the seller has limited reward. Okay, it's not unlimited. So the buyer has unlimited reward. I bought it at 61. It can go to 200, 300, 400, 500. Right? I can keep making money. But the seller, he sold it at 61. That is his maximum reward. 61 into 300, 18,300 rupees is his maximum reward. It's a limited reward for a seller. Okay, now then you would ask me, why then are there people who sell calls or puts, right? Because they have unlimited risk and they have limited reward. Here's the reason why. Okay, because probability. The buyer has a lower chance to win. Now you need to know something about options. Options have something called a time decay. Over time, the value of that option will go down as it gets closer to expiry. So when I buy an option, I have to fight two things. One, I have to believe that the market will move in the direction that I want it, but I also have to fight the time decay. Whereas for the seller, the time decay works for him. He sells at 100, and after 2 weeks, the price has gone down to the price of the underlying, say HDFC. He sold at 1,800 call. and the price at that time of HDFC was say 1,800. But 2 weeks from now, the share price hasn't gone anyway. It's still 1,800. But the time decay on the call option has brought down the price of that option. So where it was 61 before, now maybe it might be 20. So the time is in his favor. A seller will always have time in his favor. A buyer will always have time against him. And that is why actually sellers have a higher chance to win. It's just that there's a lot of more risk and the margins are huger. Okay. For example, when I bought HDFC, I paid 18,300. Person who sold that, his margin would be about 1.3 lakhs. Can you see the difference? So that is why sometimes option selling is not for everybody, but actually it has more chance to win. If it goes wrong, it can go terribly wrong. But if it goes right, you won't make a lot of money, but you have a lot more chance to win. That is why a lot of people sell options. Okay, just for your information. All right. So why do we have to do options? Now we have the ordinary share price. Okay, HDFC Bank, for example. We can buy the share itself, right? So why do we need options? Why not futures? Okay, so these are the three questions we got to ask. Why not cash shares? Why not futures? Why options? So let me break this down. One, the cost involved. Okay, so if I want to see, let's say HDFC Bank, I want to buy 550 shares. Now, one lot of HDFC for futures and options is 550 shares. Okay. Now, if I want to buy that in the share market, look at that price. If the price of HDFC Bank is 1,100, I have to buy 550, and if I have to buy 550 shares, I have to give 6.05 lakhs. Okay, a lot of money. If I want to buy that in the futures, future contract of HDFC Bank, 550 lot, I have to pay a margin of 1.37. Okay. But what if I had to just do it in options? I'll show you something. In options today, I think the 1,100 call is around 30 rupees. Okay. When I buy an options 1,800 call or a 1,800 put, whichever way I think the market is going to go, I just had to pay 16 to 20,000 rupees. You see that? For 6 lakhs, I don't have to pay 1.37. I just pay 16.5. That is the power of options. Okay, that's the cost involved. Okay, now let's look at brokerages. Now this is something that most people don't even think about. But let's look at brokerage. If I had to buy HDFC Bank 550 shares, I have to pay 1,200 rupees as brokerage. Okay, by the time I buy it and sell it, look at that, 1,200 rupees. Okay, what if I do this in futures? I had to pay 87 rupees. Okay. But I have to also give a margin of 1.37 lakhs. Okay, huge margin, but much less brokerage. Wow, that looks good, right? But look at options. I had to pay 63 rupees, and I only have to, as brokerage, and I only have to pay 16.5 thousand rupees to buy that option. Also, there's a few more things to this. Okay, one is you can if the share is going down, you cannot sell a share, short the share and hold it on the cash market. You can sell a future and short it. You can sell or you can buy a put option and make money out of it. But when the market is going down, you cannot make money out of selling shares over a period of days. You can do it intraday, but in the cash market, you cannot short over a period of days. You can't hold a short. You have to cover it at the end of the day. But futures and options, you can short. Okay, that's why when you short a share over a few number of days, people do it on futures and options, but you can't do it in the cash market. A second benefit of this is that say you're buying a futures and it goes wrong against you. The loss that you can make, see, every 1 rupee change in the share will reflect in 1 rupee change in the future normally, right? So you might end up losing a lot of money, because if you have one share of HDFC Bank and it loses 100 rupees, you lost 100 rupees. But if you have a future lot of HDFC Bank, which is about 550 shares, instead of 100 rupees, you would have lost 55,000 rupees. But when it comes to options, for $1, there's something called delta. For 1 rupee of change, the option doesn't change by 1 rupee. Sometimes it will only change by 0.5, 0.6. So on your gain side, you won't gain as much as the future, but you won't lose as much as the future also. So that's why options are a more powerful tool. Okay. So three things. One is the cost involved. Second is the brokerage. Four things actually. Third is that you can't short on the cash market for more than 1 day other than intraday. And fourthly, the potential loss is much less than when you do futures or cash. Okay, that's why options very powerful. 80% of the transactions in the Indian market is not cash trades or future trades, it's options. Okay. Now, how do we trade these options? Now, look at this. Okay, now when I buy HDFC Bank's option, when I buy it, either a put or a call, when I'm an option buyer, I don't have to give any span margin, exposure margin, anything, any of that. You can go to Zerodha's margin calculator and you can see this. Okay, but if I sell, if I'm an option writer, look at this. If I sell one option, a put option in HDFC, I'm selling it. I had to pay a span of 76 and exposure margin is 20. I would get money because I'm selling it. I would get the money back, but look at the total margin I had to pay, almost 1 lakh. Okay. So where I would pay 16.5 thousand rupees for buying this put option, for example, I have to pay almost 1 lakh for selling the put option. Now there are ways to mitigate this now by hedging, and I'll show you an example. Suppose I sold a 1,000 put option, and then so I bought a put option. I believe the market is going to go down, so I bought a 1,000 put option. Oh no, actually I believe the market is going to go up. Sorry, okay, I believe the market is going to go up. So I sold a put option, a 1,100 put option, and then I bought a lower 1,000 put option. Now look at this. Okay, this span has come to 52,000. The exposure margin has come to 22,000, and the premium is what, 22,300. Look at the total margin, 72,000. If I had just sold the 1,100 put option above, I would have to have a margin of 1 lakh. By doing this together, I have saved almost the margin benefit, 72,000 rupees. Okay, this is the power of hedging, why a lot of people do hedging, and I'll show you different strategies that people use for options. But when we do a naked sell, okay, naked sell means I don't hedge it, I just sell option, either a put or a call. The margin can go really bad, it's huge. But when I hedge it, it can go much lower. Okay, and I will show you why we hedge in all of that. Okay, this is just for you to understand margin. Okay, now look at this. Based on my technical studies, I believe Torrent Pharma is going to go back up. Okay, because MACD line is cut, the EMA line is cut. This is on a 2-hour chart. So I think this is going to go up. Now, what I've done is I've gone to Sensei Bulls. Sensei Bull is something that you can access for free if you have a Zerodha account. And I put in Torrent Pharma about 2,500. I believe it's going to go about 2,500. What are the options that I can possibly buy? And they suggested buying a Torrent Pharma 30 July 2,400 call. This is not telling you that tomorrow, because Sergeant said it, on Monday everybody is going to buy a Torrent Pharma 2,400 call. Please don't think of it that way. Okay, that's not what I'm trying to say. But this is just for you guys to understand. Okay, now so this is Sensei Bull giving me an option. I can listen to this, or I can decide what I want to buy myself. I actually can, because I really have information. I can go look up the option chain. I can see which is the better option to buy, and all of that, which is the better call option to buy, and accordingly make my strategy. But I'm just trying to show you how you can do this. Okay. So if I think Torrent Pharma is going to go up, and I think it's going to go about 2,500 in the next few days, what I'm going to do is going to buy a Torrent Pharma call option. And because I believe it's going to go about 2,500, I'm going to look at a 2,500 call option. Okay, no, this is a 2,400 call option. If I look, and so over here, the amount that they're saying would cost us is 47,000. If I look at a 2,500 call option, it'd probably be less than this. Okay. In fact, let's check it out. Okay, let's just quickly check it out. What would a okay, so I'm just quickly going to do Torrent Pharma 2,000. Okay. Let me share the screen with you guys. hang on, sorry. Okay. Torrent Farmer 2,400 call. Okay. Now it's showing me 95 rupees. So when it's 95 rupees, if I have to buy this, it's about 47,000 rupees, right? Now let me try a Torrent Farmer 2,500 call. Okay. I take a 2,500 call just to check, and it's showing me 57. So if I have to buy this, this will cost me about 30,000 rupees. Okay. Now let's look at what these numbers mean. Okay. If I were to take the option chain, I pull it out. Now you can see here the full option chain. Okay. So let's look at what Sensible has to say about that. Okay, so I've clicked Sensible and they're going to take me there. Actually, they've just taken me back here. Okay. Now let's look at this. Okay. Torrent Farmer 2,400 call. They're not showing me 2,500 call. I don't know why. But if I have to take this, okay, I have to put 47,000 rupees. All right. If I have to take the 2,500 call, it will cost me 30,000 rupees. Please don't go buy this tomorrow because I said this. Okay. This is just educational purposes. I'm not giving a call on Torrent Farmer. Please don't take it that way. Right. So let's look at what happens if I were to decide. Imagine I buy the 2,400 call. So when I go to look at this now, again, Sensible will give you option. You can look up what it cost you, and you will see things. Now I've activated the Greek options. Now you will see a lot of stuff. Okay, you say what is delta, what is vega, what is theta, what is gamma. So let me just quickly say what are these. Okay, these are Greek, and trust me, it is Greek. Okay, delta basically means that for every 500 shares, okay, now the quantity is 500, right? For 1 rupee difference on the cash price, it will change by 500. If I had 500 shares, 1 rupee change, 500 rupees change, right? But for the future options, it will change by 260. So you remember futures, I said when 1 rupee changes in the share price, futures will also probably change by 1, but the options might change by maybe 50, 60 paise. And so that's what it shows, that for 1 rupee change, the delta is basically showing 1 rupee change in the share price, on the underlying share price. In this option will change by 52 paise, either going up or down. Okay, now the vega is actually a measure of how volatility affects this. Again, I want you to know these are not very important things, for you to make a decision. Actually, what you just need to know is, some people study all these Greeks, all the option Greeks, but I don't think you really need to do it. I'm just telling you for your information what these things are. Okay, so the vega is basically a measure of how volatility in the market can affect the share. Okay, that's about it. You don't have to really, figure out what and wow, what is all of this. And theta and gamma are again additional number. Gamma basically says how much is the change in delta. As you go higher up or lower down, how much would delta change by? But again, I just want you to know these are not really important. Some people really want to know what all of these mean, but it is not really important. The key is to know where the market is going to go. If you can figure that out and take a call or a put option, if you hedge it also, they're really good. But basically, these are not very important. Some people do it. I personally don't even look at the Greeks. Okay, I just look at which has the most open interest, which is the more, which has more volumes, which option has more volumes, and accordingly I'll buy or sell. Now, for example, now Sensible also gives a lot of suggestions. So here's a suggestion that they put up, and I just put it here just for you guys to see it. They're saying that most likely the bank nifty is going to go down next few days, and so if you do this strategy, here's the potential profit and loss you can make. So for example, if you buy a 2,500 call option and you sell a 22,000 call option, you're going to say that the market is going to go down. When you sell that, you will get about 180 into 20, so that's about 3,600 rupees you will get in hand immediately. That's your projected profit. Okay, and then you can, they give a suggestion, you can enter it at this level, which is still good for entry if you want to. Stop loss will show where you have to exit it out. After this, it's going to be bad. So try to exit it out. Maximum stop loss 22,600 is the maximum loss you can face. So once it goes beyond 22,000, you start losing money. Once it goes past 22, I don't think it's 22,000. I think this price is somewhere at 22. This is like 22,200. So if it goes beyond 22,200, you're going to make a loss. Start making a loss. Okay. You can break. You can exit with 0 rupees if you get out at 22,200. But if it goes beyond that, you know, it's an issue. And so this is a suggestion that they have. So again, and by the way, this is a spread. I'll show you what a spread option is, a spread strategy is. But this is basically, you know, thoughts or suggestions that they will provide to you. Okay, so let's look at these option strategies. There are a lot of option strategies. Okay, now you will notice that the ones that I've done are actually all naked options. Naked options doesn't mean they don't have flows. Naked options basically means no hedging. I just bought. I'm saying, look at Tata Motors. I bought it at about 101 when the share price was 101. I bought a 105 call option, and I said I believe that the Tata Motor price is going to go up, and so I bought the call option at 6.1. I did not hedge it. It went up to, it actually went up to 8 point something. I was looking at 14,000 rupees gain at one point, but eventually I closed it at 7.5-ish or so. And so none of my options were actually hedged, you know. But because they're all buy options rather than selling options, I haven't written any of these options. I bought these options. I will, if I lose out, I will lose the cost. That's it. Okay. If I lose out completely, I will lose the cost. I can hedge this too. I haven't hedged any of these, but I could hedge them if I want to. But I believe that I have an edge. I believe that it's going to go with what I'm saying. So that's why I've gone like that. I can still make a loss. You can see the last three. When you make a loss, you make big losses. When you make profits, you can make big profits. Okay, on options. And so let's look at some strategies. Now there's a spread strategy. So if I believe that the and that's that you saw a put strategy. Put strategy for Bank Nifty, but a call strategy is where I believe it's going to be bullish. And so what I'm going to do is I will buy a higher call option and sell a lower call option. Okay, if I believe that it's going to be going forward, it's going to be bullish, I can buy a higher call option and sell a lower call option, or I can sell the higher put option and I can buy a lower put option, which is what I suggested for HDFC. If you see, remember that the exposure margin, you look at this, this is where I believe that HDFC Bank might go up. So I sell the higher put option and I buy a lower put option for the margin benefit, but also to minimize my loss. Okay. So that's a spread or bullish spread. A bearish spread is what we saw for Bank Nifty, okay, where we would sell the lower call option and buy the higher call option. Again, this is to basically limit your profit and loss. Okay, the hedging is to basically limit your loss. Still can make a loss, but to limit your loss. There are ways to how to, for example, I'll give you an example as we come down. Okay, so this is a spread option. There's something called the straddle strategy. Okay, so there's a long straddle where, or a bullish straddle where this one I tried on Friday. I wasn't sure where the Nifty was going to go, so I bought a call option and I bought a put option on the Nifty, and said, okay, whichever way it goes, I will sell the wrong one off and hold on to the right one. So eventually, I closed them both for a small loss. I think it wasn't going anywhere. But this is a strategy that we would use when we're not sure where the market is going to go. I know it's going to go somewhere big. Okay, it can either go down very fast or it can go up very fast. But right now, I don't know where, so I'm going to buy both the call and a put option. Whichever way it goes, I will hold on to the right one and sell off the wrong one. Okay, and so that is what a long straddle or a bullish straddle does. There's also a short straddle. Now, a short straddle is the opposite, where you're not buying the options, you're selling a call option and a put option at the same price. Okay, you sell, you can see that both the put and the call prices, strike prices are the same price, and you sell both of them. Now, what happens when you sell? Eventually time decay works in your favor, and it's going to, your profit is going to keep coming. But this will start losing out if it makes a violent move upward or a violent move downward. Okay, but usually if it's the market is volatile, it just goes up and down and comes back to somewhere where you sold both the options, you're going to make a lot of profit. And a lot of option sellers will sometimes do a short straddle. In fact, the most famous option seller in India, it's a guy called PR Sundar. I follow his thoughts. I've even asked him, can you mentor me in option selling? And but he does a lot of option straddle or a short straddles. He will enter short straddles because if the price doesn't move, he's going to, at the end of the expiry, he's going to make a lot of money. Okay. Now that's the maximum profit. You see the profit is limited. Okay, you can't go beyond that. But the loss is unlimited. That's the danger when it comes to selling or writing options. Okay, so that brings us to the close of today's session. If you want to register and learn with me and trade with me, please do go to bit.ly/KWC Plan 1. For those of you who came in later and want to see what happened, also remember to subscribe to YouTube, Kingdom Wealth Creators on YouTube, and follow us on Facebook.